Are you concerned that you haven't paid enough into the IRS this year and think you might need to make an estimated payment and want to know more? You're in the right place. I'm Bridget Sullivan Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shearer. I've got a fee-only financial planning practice in Middleton, Wisconsin. Before we dig into the details of how to stay out of hot water with the IRS, I want to remind everybody to hit that subscribe button. That helps other people find this information on YouTube. And with that, let's dig in. A lot of our questions at this time of the year, Bridget, in my practice, I suspect in yours also, are revolving around this idea of making estimated payments to the IRS. People have maybe had a windfall of some sort, is where we see it, inherited some money, and geez, am I going to owe some money? Do I need to make an estimated payment? Or had stock options that exercised, or my company went public, or I did a Roth conversion, took some money out of my IRA. Do I need to make an estimated tax payment for fourth quarter by January 15th? I don't know if you're hearing a lot about those questions in your practice, but I'd be interested in your take.
I've got more examples too. I started a business this year and I've got some income. Yay.
Yeah.
And also I got a big bonus and they withheld, but not quite enough. I don't think they withheld enough.
Yeah.
So, and those are all good examples of when you might need to make an estimated payment. Now there's two ways to figure out estimated payments, which are generally just what the IRS wants. The IRS, they like to get paid equally during the year. They don't like to get paid all at once on April 15th. And so they say, pay us equally over the year. And that's what estimated payments do, is help you pay equally over the year. Although
if I could jump in on that, it's sort of like when you're working, right, and you get a paycheck. What happens in your paychecks, right? Automatically, they withheld taxes. Every pay period, some money goes to the government for taxes, right? When you're working and you get a regular paycheck, that happens. But these instances we're talking about, right? I've got a business now. I'm making some money, and maybe I inherited money where there aren't any withholdings from your investment gains, right? From the business, if you're running a small business, maybe from your stock options. So that's where those estimates come in, right? It's kind of like what most of us are used to with withholdings from our paychecks, but this is those things that don't get withheld is where the estimates come in, right?
Absolutely. And that's a good way to look at it. Usually people know that they're in the estimated payment situation, but they're anxious about it. And it's like this whole subsystem. 90% of the people have never heard of estimated payments and will never hear of estimated payments because they just never have to do it. And so, because they would have withholding like directly from their paychecks, and then they get directly from their IRAs, and then they get it directly from Social Security, and they never have to do any estimated payments. But then other people, so there's a lot of confusion when people started out, because they're like, I've never even heard of this. And yet you're telling me this is common. It's like, yeah, it's common. But again, only 10% of the people need to do it at any given time. And probably only 30% of the population even know it exists because of the way that the tax system works. So how to figure this out? There's two ways to figure out how much estimated payment you need. And the first way, which I think is probably the most common, and it's certainly most common from the situations that we're describing to you, big jumps in income, is look at your previous year taxes. So right now it's 2023. So we'll look at 2022 and make sure that you've paid in, if you are single, and you make less than $75,000 a year, you need to make sure that you pay in 100% of last year's total tax. Okay. And if you make over 75, it's 110%. So you multiply the total tax last year, not how much of a refund you got or how much you owed, but the total tax, which is a number that most people don't have much relation to, but that's what you want. The total tax last year times 100% or 110%. And if you're married filing jointly, it's twice the 75. So it's 150. Yeah. John, you have anything to add there?
Yeah, no, it's funny that how you described it is exactly right. I know that those are the facts. I think of it as just saying, listen, if you pay in 110%, then you're safe, right? Look at last year's taxes, and it's on page 2 of the 1040, right? About a third of the way down or so, your total tax, something like that. And you go, oh yeah, that's right. And I love that you said it's not what you owed at the end of the year. That's what your tax bill was for the year. Most of it gets prepaid with those withholdings and things. Hey, I owed $20,000 in tax last year. This year, if I pay in at least $22,000, I'm safe, right? It's called the safe harbor is what they call that, right? So, okay. And as we're talking about this, Bridget, I realized that safe, well, what does that mean? Safe from what? And we never talked about, when I was explaining sort of why we need to do this, is if you don't pay in enough throughout the year in either withholdings from your checks or in quarterly estimates, then the IRS will assess an underpayment penalty to you when you do your taxes in the spring. So to avoid that underpayment penalty, it's that 100 or 110% of last year's taxes are one of the metrics, right?
Absolutely. And what is the underpayment penalty? First of all, I like to make sure that people understand that it's the least penalty. It's really interest, that it's the lowest of anything that the IRS does as far as penalize people. So right now, and we'll put a chart up here, it is 7% for the first 3 quarters, and then 8%, and that's 8% annually, but that's for that quarter, and it's compounded every day. So I describe it to people really as the IRS wanting to encourage you to get it out of your savings account and at the IRS. So that's what the motivation is. It's not as much to really punish you as it is to encourage. There's many other IRS things that are punishment, but not exactly this one. So I tried to lower the anxiety level with people a little bit that way.
I appreciate that. And well, folks, sometimes if you do end up paying a small, underpayment penalty, and when you say penalty, like it gets you anxious as you just
Right.
described. And no, like the IRS doesn't care, right? It's not like it's a red flag, like you're cheating on your taxes or something like this, right? Which some other things are, like, as you just well described. Hey, this isn't punishment. It's like, listen, we want our money and we got to charge you interest on that. I've had folks in the past that say, listen, it's underpayment interest rate, the penalty is 7%. Well, shoot, I'm going to leave my money invested, and more times than not, I'm going to get more than 7%. I'll get 10% on my investments, and I don't care about the penalty. I'm not sure
Right.
that I subscribe to that personally myself, but it's not like you're cheating. It's just, that's what the rules are, and you follow the rules. So it's not a big deal from that standpoint. So I really appreciate that viewpoint. You had mentioned, Bridget, that there's 2 ways that you can avoid this underpayment penalty. One is paying in 100 or 110% of last year's taxes. What's the other method
The
for
second
getting
way is to pay 90% of what you ultimately owe this year. So that means you have to have a decent projection of what you're going to owe this year. And if you've got a small business, it can vary. It can be surprisingly different than what you think it's going to be. So it can be a little bit harder to get your finger on exactly what that number is, but you can usually get approximate. So that in those cases, I try to help people approximate, okay, what do we think the total tax is going to be? Even if you knew, okay, it's less and less, I know my income's going down. Here's what my tax was last year. Okay, what do I think it'll be this year? I know what my income is. What do I, just do some sort of proportion there.
Yeah.
And that again can get you to the 90%. Another maybe a little known fact, John, is that you get a get out of jail free card, or maybe that's bad wording in this context. But if you get the year you get married, you're not subject to this. You've got an exception. Yeah,
I didn't
because
know that.
the IRS can't keep track of 2 tax
Yeah.
returns together. So,
Yeah.
so anyway, you can click on a form, there's a button to click, and then you should be good with underpayment penalty on the year that you get married. The other thing is that if you get a lot of money at the very end of the year, then the IRS, if you don't tell them this, if you don't say, okay, this is all at the end of the money, at the end of the year, by doing what's called an annualized, there's an annualized statement, an extra form to fill out. And in that form, you show exactly when you got everything. when you got
Yeah.
all the different parts of money. So it's kind of a pain to fill it out. I filled it out a lot when it's high. You know, if it's $100, I probably wouldn't bother filling it out personally. So your tax preparer might have some sensitivity to, because it's a somewhat kind of time consuming form to figure out, because you have to figure out how much does this taxpayer have on all these arcane tax or arcane like it's the first 3 months, then the first 5 months. It's like who divides by 5 months? Like
Yeah.
when do you have to have your income sliced and diced that way? So and all your deductions. So it's not crazy, but it does probably take some time to do. So sometimes, unless it's a large amount, preparers might just say, hey, pay it.
So are you saying that the IRS rules aren't completely logical and orderly? Is that what I'm hearing? I might make a note of that. Yeah,
It's true.
it's a weird thing. I'm glad you brought that up, because we've had some folks where, especially as we're here in the, getting towards the end of the year, thinking about do I need to make a fourth quarter estimate? A lot of times it's for doing things like Roth conversions. We took money out of our IRA and put it into Roth, or we've got a year-end bonus and maybe they withheld some taxes, but not quite enough from that. And as you just described, right? If you leave, we've had folks that have Roth conversion and it's $200,000 of extra income, right? The IRS looks at that and they say, oh, you made an extra, $15,000 or $18,000 each month throughout the year. You owe us taxes going back to January for underpayment. And you go, wait a minute. No, I got all that income in December. I just have that 1 month and I made an estimated payment for the fourth quarter, right? So it matches those things up. So I think the important takeaway for folks is if you have income that came in during the end of the year, as we're talking about now with some of those sorts of things, make sure you let your tax preparer know, hey, that wasn't received in January or April. It was received in the fourth quarter, so that they can make that form and make a decision on getting that filled out and avoiding some of those penalties, right?
Right. Absolutely. The last thing I want to mention is that you should also be mindful of your state, if your state levies income tax. So I'm in Illinois. It's easy to figure out Illinois because a lot of Illinois income it's easy to figure out how much to withhold in Illinois because it's a flat tax. So, and I can easily see, okay, you really just need to withhold or make an estimated payment for interest, dividends, small business, and IRAs, Social Security are not taxed in Illinois. So it's easy to figure out, but Illinois, and also withholding is usually covers exactly what they need from their W-2. So with Illinois, the thing is that it's a smaller amount because the Illinois tax is obviously lower than the IRS's or the federal tax, but the penalties are worse. So they don't have this 7%. Oh, it's the lowest penalty ever. They've got we want you to pay. So I encourage people to pay all of Illinois. Don't wait. Don't even mess around. Give yourself cushion. So that's my 2 cents. And so I want people to just say, okay, don't forget about my state.
That's awesome. We're talking about avoiding federal underpayment penalties with that and follow the things that we've laid out here, but make sure you pay attention to the states.
There's one more bonus before I say please subscribe, which is if you're going to owe less than $1,000, you don't have to do it.
Oh yeah, great.
Okay.
Great. Yeah, don't worry.
So with that, I'm Bridget and Ramel. I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. Both Bridget and I are taking on new clients. We'd love to hear from you, but if you like what we have to say and you'd look for an advisor in your local area, we're both members of the Alliance of Comprehensive Planners. So if you'd like to find a planner who thinks like us in your local area, go to acplanners.org.
And please subscribe.